The Finance Minister, Nirmala Sitharaman, has hiked short-term capital gains tax on certain financial assets to 20% and long-term capital gains tax was hiked to 12.5% on financial and non-financial assets. Finance Secretary Mr. Somanathan clarified that the idea was to bring equity in capital gains taxation. He's also ruled out further hike in taxation, at least for now. To discuss this further, I'm now joined by S. Naren, Executive Director and Chief Investment Officer at ICICI Prudential AMC. Naren, great to have you with us here. I want to just start with that bit first, which is, what do you make of the clarification, almost a promise that they will keep the rate at 12.5%, at least for the foreseeable future?
I think basically the markets can absorb it. That's why you would have seen yesterday that the market basically closed almost flat. And so from that point of view, I would say markets can absorb, equity markets have the capability to absorb at this point of time, given the kind of inflows that the market is seeing at this point of time. So I don't think there is a problem in equity markets because of a taxation increase. If the problem was there, we would have noticed it yesterday at this point.
And so it's done and dusted, right? Behind. It's not as if there is any lingering impact from here.
It's not that. See, we have to recognize where we are in the markets. We are in a market at this point of time where valuations are high, sentiment is exuberant, macroeconomics is fantastic. So we are, and India is one of the best structural stories in the world for the next few decades. So the combination makes it very complicated, because do people look at the next few decades of structural growth and say, let's pay up for it? Or say India is one of the best macro in the world? Or people say valuations are so high compared to the rest of the world that you have to be cautious. Which of these things do you look at? It's a very difficult problem, particularly for a global investor. From a domestic investor point of view, people, I think, are not investing in debt at this point of time, because they're looking at the remaining two and saying that let's look for the long term. So that's why the government has done something more interesting outside equity, which is bring down the price of gold substantially, reduce the capital gains tax on real estate. So, we are not experts in these asset classes, but how do people react to that? How do people react to a big drop in customs duty and gold and drop in capital gains tax on real estate without indexation? It beats me. I'm not able to understand, because yesterday real estate stocks were down because capital gains tax on real estate was down without indexation. So this is something which maybe I
wouldn't. Naren, so we were just discussing that before you came on real estate. Is it for legacy old property? This is negative. I mean, if you bought something very cheap 20, 30 years ago, and now you're going to pay it for, this tax without indexation. But for new property sales, isn't this, even if you buy something now and you sell after 24 months, you pay 12.5, not 20. Even if you bought at that point without the intention to sell, in theory, the taxation is now much lower. So from a stocks perspective, isn't it positive?
Yeah, even forget from a stock point of view. Today, for example, if I invest in a 2-year, in 2 years in our liquid fund or money market fund, you are in the top tax rate, you end up paying more than 33 or 38%. Whereas you invest in a property and sell after 2 years, you're going to pay 12.5%. There's a huge difference in taxation between investing in real estate and investing in debt mutual fund today. Is that something which is logical at this point of time, that debt mutual funds are the most hated asset class at this point of time? So I think slowly over a period of time, the government is saying, do not invest in debt, and invest in property, invest in equity, invest in these kind of asset classes. And that is what may happen, because slowly over a period of time, debt has become the only asset class where you are charged at the marginal tax rate, whereas both in property and equity, you get very, very favorable tax treatment at this point of time. So is that I don't know.
Naren, hi. I was going through a piece that you had put out where you mentioned that now you're starting to get a bit cautious on the mid and small cap space. And across the board, you are seeing a bit of fair valuation, slightly higher, above fair valuations for the broader market. So what does one do now? If you get a dip in the market, do you think the best way to approach it is to stick to large caps and perhaps churn out of mid and small caps?
So actually, for the last 1 year, we've been cautious on small and mid caps, but small and mid caps have kept going up. And it reminds me of the period, we used to always come on TV and say FMCG, we are cautious. And FMCG used to continue to outperform. Then we have had a 3-year run between 2020 and 23 where FMCG underperformed the market 100%. So we seem to be into one of those phases where we continue to be cautious on small and mid caps, but small and mid caps keep going up. But what happens is what we've seen is when you have these accumulated underperformance of overvaluation, it shows up later. And when it shows up, you don't know. No one knows. But we are believers in asset allocation first. Then we are believers in flexi cap and large cap. That's how we look at it. Doesn't mean that today onwards, small and mid cap starts underperforming. The more it outperforms at this point of time, just like what happened in real estate between 2013 and 2020, or in consumer stocks between 2020 and a few months back, you can have long period of underperformance after the overvaluation. And we are not astrologers to know when the top of this FMCG or top of real estate will happen. If we knew, I would tell you, but I don't know.
All right. Hi, Naren. Tell us your thought process now on some of these value buys. Energy fund has raised a fair bit of money. Stocks like NDPC, ONGC in the past have been quite positive on. What's the thought process from here on?
Finally, at the end of the day, there are three things we depend on. We are dependent on moving from one place to another. So we need energy. Without power, we can't do this. Without telecom, we can't do this. See, we have always believers in this, but even these three sectors are not cheap. So the public has given us a lot of money to manage and given us a tough, responsible job on how to handle this market, because I wish these stocks were cheaper. So we'll have to handle this fund with the care that it deserves, given that public has given us the money. So it's a tough job. The challenge in the mutual fund industry is, 4 years back when the stocks were cheaper, we had to defend our investment in these stocks. Today, when the stocks are costlier, people have poured money and given us. So that is a tough job that we have, and how to handle public money in this area is one of the tougher jobs. But markets across the board are not cheap at this point of time. And we have a tough job grappling with all the money that we have and have to manage on an incremental basis. That is why we tell people be defensive, follow asset allocation, and that's the way to go. And it has nothing to do with the budget. I think it's a super budget. They have done exactly what is needed at this point of time, because in all areas where things can be borne, they have increased taxation. But there is no way in which you can have a situation where it means that markets are cheap at this point.
You've been kind of championing how debt has been ignored as an asset class. Everyone is piling into equities. And now you got this, as you also said. You said, well, the indication seems to be from the government that don't invest in debt. Invest in gold, real estate, maybe stocks, of course, with higher tax even. But debt, it becomes very unattractive in that sense. Would you agree, Naren? And would you see shifts in terms of flows from investors?
I don't know. I think inadvertently this seems to have happened at this point of time. I don't know what is the situation. I think, but I don't think it was a planned thing. But government, whether it's a government, what's happened, it's very difficult. But right now, for us, for example, we are not able to convince any of our investors to invest in debt mutual funds. They are very, very equity focused at this point of time. That's what we're seeing at this point of time. So, but what we have seen over a period of time is debt plays a very important role in every person's asset allocation. So instead of focusing on debt, we have to think of getting them into asset allocation strategies or hybrid strategies at this point of time. And that is what we try to get people to do at this point of time.
Got it. Just one more. I just want to press this in. Rural allocation from the government. I take your point on the volatility bit. Rural allocation for the rural sector is down once again. I think it's down for the last 5 years. Every year it's down. So there was some expectation that at a mass level, rural, etc., there'll be that support from the government. It's not happened at all. Just your thoughts on any bets that people have been making and any implications for stocks.
I'm not an expert because if you look at the way MNREGA allocations have been going up and a lot of indirect things that are happening, for example, most of the road construction that happens through the highway programs in various ways, even the expressways happen in rural areas. So how you count the rural allocation is a bit of a this thing. If you look at the way, if you talk to most of the construction companies, they tell you it's so difficult to get labor at this point of time. So, I mean, it's very difficult to correctly predict what is the amount of money which goes to rural area directly and how much goes indirectly. So I think it's not fair to the government to say rural allocation is not there. It goes through direct channels and it goes through indirect channels, and that is how we see it. And maybe that is uh, just looking at just some rural indicator alone is not the way to look at it.
No, I completely take your point, direct and indirect. But the printed number is what I'm going with. So that is down. That's what I meant.
Yeah.
Naren would have sort of lots of other points to discuss, but we are completely out of time. And you have a very busy morning as well. So thank you very much for being with us here on CNBC TV 18.
Thank you.